Welcome to the Business Finance Matters podcast. Over the next 15 minutes, we're going to tackle some of the topics that we get asked about on a regular basis so you business owners can get a better understanding of what it is that you're probably dealing with on a day-to-day basis. Let's get on with it.
Well, David, here we are again. Good to see you, my friend. How you doing?
Very well. How are you doing?
Well, you sound a bit miserable, mate. Cheer up.
Oprah Winifred.
You're off on your hole soon, aren't you?
Go. What you got for me?
Well, I tell you what, this is. We always said we try and make things as relevant, but this is quite topical, and I think it's been going. I want to talk about short-term lending in the business market.
Yeah.
So let's just define some of these words to start with. When we say short-term lending, what sort of period are we talking about here of a facility? We'll talk about what the facility is in a minute.
Short-term, I would say typically is 12, 24 months maximum.
Okay. And the facility, we're not talking asset finance, invoice finance, trade credit. What are we talking about here? What's the product?
Well, as you know, under the banner or the title of business finance, there are a number of financing options with different names, which is often confusing even to the likes of myself. But you can imagine business owners trying to identify with all the different names that are given to these products. But if we keep it in layman's terms, typically these short-term loans are loans.
Yeah.
I mean, there are different types of products under the title of loans.
Yeah.
Cash flow, credit lines, whatever you want to call them. But typically these are designed for businesses that are looking for access to an amount of money that ideally we want to be repaying quickly.
Okay. Now, this is interesting, isn't it? Because, okay, so we've identified it's 12, 24 months. We've defined it's a loan. Would it be fair to say it's not a bank facility, really, is it? I mean, where are these?
No.
What sort of companies are providing these loans?
No, I mean, banks do obviously offer a number of short-term facilities. No, but based on what we're discussing today, what we're probably honing in on is the independent lenders. And there are a handful, if not more now, that provide these short-term loans. And they are literally typically from, as I said to you before, even though they have a 12 or 24-month term, these can be repaid early. So there's a flexibility in there. Typically, they're independent lenders. And hopefully, these types of products are being used for businesses that need access to finance, but ideally, and we'll probably come on to this in a minute, need to be repaid reasonably quickly. So just because there is a 12 or 24-month term available,
okay,
ideally from an intermediary point of view, because, again, we'll probably talk about this in a minute, because the interest rates tend to apply, we want to get them paid down sooner.
So then just to summarise quickly then, so probably from non-bank lenders, short-term, the product is a loan. You're suggesting, although the facility might be 12 or 24 months because there's potentially a higher interest rate or quite a high interest rate, you would advocate that the customer pays it early. Why would you use such a facility? Where do you see it being used?
Well, again, it's all down to our decision making, really. Bearing in mind that everything I do and everything that the guild member does is for the best outcome for the business owner.
Right.
So if we have a situation, and I'm working on one at the moment, and I've been speaking to some other guild members recently who have similar situations where we have a business, for example, that has a VAT bill, that's cropped up. The cash flow isn't quite as good as it should be. However, cash flow looks like it's going to improve because maybe it's a seasonal business, for example. So as we're coming into spring, therefore, this type of product is ideal. So we just want, quick access to finance.
Yeah.
Because we want to get this VAT bill paid. And ideally, once the cash flow improves, then we want to get this paid back as quickly as possible.
And that's interesting because that takes me back to one of the other podcasts we recorded. We were talking about business planning, weren't we, and cash flow forecasting and all the rest of it. You could be the best person at doing that, but it's you don't know. There's an unknown, isn't it? God forbid the ceiling falls in, or whatever. It's that
it is.
If you've not got a stash of cash, it can be quite good.
Another typical example is invoices not being paid on time.
Right.
As we've already spoken about before, there's a product called invoice finance, which has its value.
Yeah.
But if it's just a short-term requirement, there's an invoice, for example, or VAT, or just a requirement to repay something, and we want to get it repaid as quickly as possible for a number of reasons, what is the repayment plan? Ideally, as I said before, just because it's a 12 or 24-month facility, the majority, if not all, of these short-term lending products will allow you to repay early.
And another question I've got for you, do they tend to be secured against anything? I mean, we talked about charges, debentures, or are they unsecured? I mean,
Depends how you define secured and unsecured.
Okay.
Typically, all of these are secured by personal guarantees.
Oh, right, okay.
But not on houses.
Right.
Not on assets.
Okay.
But on the individuals.
So would that suggest that they're fairly easy to obtain?
Yes, they can be.
There's a little wry smile on your face there.
I think it's all fair to say that the marketplace that we work in, as you know, from information that we get back from the members, from information that we get back from business owners, that access to this kind of finance is relatively easy. And the reason that it's easy is that most of these are, I say most, I'm generalizing, but they are tech-driven lenders.
Okay.
So therefore, information goes onto the platform.
Yeah.
So the business owner will put its information in there. They'll be asked to provide bits of information. It will go through. A computer says yes. And again, I'm generalizing. Computer says yes, just no process. And before you know it, approved. And again, generalizing because it's case by case.
And not wishing to delve into the lender market or the lender sector too much, but that's relatively recent, isn't it? I mean, these lenders didn't exist 10, 15, 20 years ago, did they?
No. I mean, again, we haven't got time to talk about it, but these are types of loan products that have evolved over a period of time. In following the banking crisis, there have been lenders coming to market more and more and more so. Lending options evolving, becoming more and more and more so, and I can't see that changing in the foreseeable future.
But let's be honest, on the face of it, as a facility, it sounds pretty good to me. If you're running a business and if God forbid something happens that you don't know or you only need it for a relatively short term, it does sound quite appealing.
Well, it's all about, as we always say in every podcast, it's all about what's best fit.
Yeah.
What's the best outcome? I mean, the last thing we want to do is put someone into any type of debt if it's not good debt. And most importantly, we don't want to put them into any type of debt unless we understand the reason for wanting that payment. So again, there are a number of reasons why short-term lending can be a problem.
Yeah.
But is there an exit route? We're always looking to make sure that the short-term requirement can be ideally repaid, without going down that full term.
Okay then. So again, I don't want to dwell on this too much at the moment because I want to talk about some of the disadvantages in a minute. But I would imagine that it's a facility that also carries fees. A commitment fee.
Well, they all do. And again, it's our job as members of the guild to make sure that this is all disclosed from the very beginning.
Okay. So we'll cover that, I think, another time. Right. So look, on one side of the scale, on one side of the balance sheet, for the argument's sake, the positive side, the asset side of the balance sheet, good for short-term lending, relatively simple to obtain, relatively simple to understand. Yes, it's supported by potentially personal guarantees, but as a product, it's definitely got a place in the market.
Definitely.
Now we're going to go to the other side of the equation. What are you seeing as to how this can get a little bit hairy, shall we say?
It's like any form of debt. I know as a young man, for example, I got myself into a bit of trouble because I know I had 2 or 3 credit cards.
What was in it? Oh, right. Sorry.
It wasn't that.
I was going to ask her
other.
Okay. All right. Okay.
But no, I mean, I was, like we all do as we grow up and we try and learn about life. And money was an area which, I struggled with as a youngster because as far as I was concerned, if I've got Barclay card here and I've got a store card here and, before you know it, you've got this debt that's creeping up. And then what do you tend to do? You pay the minimum payment, don't you?
Yeah.
Which covers off the interest. But before you know it, there's an accumulation of debt.
Yeah.
The challenge we have with this typically, and I'm saying this is just generalization of what we're seeing and what we're hearing, is that businesses that typically don't come through a business finance professional and therefore they are going for or putting applications in for short-term finance and being approved, as I said, maybe just by yes and no, a tech process, then these are easy facilities to grab hold of.
I was thinking about this the other day before we started. Do you think that's because that these businesses, which you'll say are data-driven? Yeah, so the data is, let's say, comes from all sources, but it comes from Companies House.
Correct.
And we know that Companies House data is not up-to-minute data. So the last filed accounts could be 12 months
plus.
or more plus out of date.
Yeah.
But if that's not going to change, if the lender's not looking at much else...
Correct.
I mean, I'm not being funny, but you could probably get 4, 5, 6 acceptances fairly quickly, couldn't it?
And it is going on. It's going on a regular basis. And I know a lot of our members talk about it on LinkedIn, for example. They call it debt stacking or loan stacking or whatever the jargon is. But I think the term is quite clear. You're putting one debt on top of another.
Yeah.
And before you know it, if you use my credit card experience,
it's a good
this
analogy.
debt is building up.
Yeah.
And what it's doing is it's pushing the business's cash flow position into a negative. And then guess what's happening?
Yeah.
Certainly as far as guild members are concerned, we'll get, a call from whoever, it may even be the business owner themselves saying, I'm struggling with cash flow here. And we will always do a due diligence. There's no way we will put an application up to any short-term lender or any lender for that matter, unless we're comfortable with the financial situation or the financial information that we're provided with. So
I'm working this out in my head, and I've said many times before, I'm not at the coalface. You are. You are speaking to customers day in, day out. Our guild members are speaking to customers day in, day out. But from the outside of that looking in, I can see that it's almost a spiral as well. It's not just what you call it, stacking or something.
Loan stacking.
It's a spiral. I mean, they're borrowing to pay for borrowing.
Correct. It's bad debt. It's what I call. There's good debt and there's bad debt. Yeah. And look, there's no blame on anyone in. There's always a blame somewhere along the line. You could argue that the business that's gone direct for this finance and getting it is perhaps doing it without due care and attention, and in some cases you can understand why they're doing it because it's panic.
Definitely in the present climate, economic climate.
Unfortunately, we're getting the situation where there's a blame culture that we work in, and there's a lot of people saying, well, why are lenders lending when they shouldn't be lending? Well, okay, in theory lenders won't, but because of the process, that how easy it can be, we're urging every business owner, do not go for any type, hang on, this is important,
all right,
do not go for any type of debt without taking the advisory or the guidance pathways that people within the guild, for example, are offering free of charge.
Well, I'm glad you spoke over me there. I mean, I was going to make that point. There's a place for this product without a doubt, isn't there? I mean, we can see that, and I think it used correctly.
Correct.
But it goes back to what we keep talking about is we don't, business owners don't know what they don't know.
Correct.
Ultimately, they can see that there's cash due to go out the door fairly shortly. They haven't got it, panic. What do they do?
Yeah, absolutely.
And tap, tap, tap. Before they know it, £500,000 in 4 minutes, and then, they haven't got to walk out the front door. I'm not saying that's exactly how it happens, but that's how it could happen. But the point being is, by the sounds of it, and you've always said this, you and your colleagues, you're with the customer for the whole journey. It's not just, it's preparing for finance, it's obtaining the finance, it's managing the finance, isn't it?
100%.
So would it be fair to say then, when you use a short-term product for one of your customers, is it part of a bigger plan? Is it a part of that's right for that customer at that moment?
Absolutely.
And then you're looking at, well, what's next stages and what's next steps?
Exactly. You said it perfectly yourself, Trevor. Well done.
Well, there you go, mate. Listen, that's a really important one, I think, and I think we could talk a lot more about that. Like you said,
it's a lot to talk about, and I'd love to do another podcast on this.
Well, we may well do it, but use right and use in the right situation, in the right circumstances. I think it's great.
Absolutely.
But I think the fear I have, and I see it, and I hear it from you, and I hear it from a lot of people. The simplicity, I was coming into the studio this morning. I heard on the radio that sometimes you got to trust you're doing the right thing in business. You got to trust your partners as your suppliers, and trust is very difficult. And often convenience outweighs and speed outweighs everything in that trust analogy. And it's that, and you might be in a set of circumstances where you've got to do something quickly.
Absolutely.
And you lose sight of what you're supposed to be there for. So, proper planning, talk to someone like
proper
yourself.
advice and a proper exit route out of any debt, making sure that we've got that in plan. Yeah,
that's a good message, mate. I like it.
Thank you very much.
Good to see you, Rascal. All right, take care. Cheers.
Bye. Thanks for joining us on this podcast. We hope it was useful. Please share, please subscribe so we can share this content to as many business owners as we possibly can. And if there was anything we haven't covered in this particular episode, then please let us know. Drop us a line. We'll be happy to talk about it in future episodes. Thanks again.